Brought to you by Prescient Investment Management. Informed by science. Guided by insight. Prescient Investment Management is an authorized FSP.
Welcome to another really educational episode of Honest Money. I'm saying it's educational before we've even started because I know the topic, and I'm excited today because we're talking about different kinds of investments that are available to us as individuals, and I'm really thrilled to have a repeat guest now for the second time, Rupert Hare, who is co-head of multi-asset at Prescient Investment Management. Rupert, thanks so much for joining.
Yeah, thanks very much, Warren, and thanks to the listeners. I'm surprised you invited me back, but I'm very honored to be back.
The feedback I've had so far is you've got a voice for radio, so I'm going to let you talk, and I'll just do sign language in the back.
Sounds like an easy one for you.
So, I think the world of investing is often kind of seems almost a bit mysterious and a bit overwhelming to individuals who are starting out and trying to build up their portfolios. And I say to the individuals starting out, I think even professionals find the world of investing overwhelming sometimes. So I'm enjoying the fact that today we kind of just to get to break it down a little bit into kind of the nuts and bolts of investing and what are the different kinds of investment types that are available to us. So I think I'm not going to steal your thunder to kick over.
Yeah, sure thing. I mean, you're spot on there. It's such a difficult world to enter into from the very start. So you're exposed to all sorts of adverts and concepts. You're never quite sure which asset manager you should pick. Should you pick an asset manager? Should you buy stocks individually? What should you do? And if you do pick an asset manager, then which fund for the asset manager should you pick? So just broadly speaking, the investment universe, in particular within South Africa, and I talk the traditional investment universe, it goes further than this, but let's start with the traditional side. It's split largely into interest-bearing investments, those being low-risk investments where you get incomes and interest, similar to bank products. In fact, I'd say bank products fall within that. And it focuses on the short term. So it's not a long-term growth type of investment. It's more of a short-term monetary need of investment. Then next up, I guess on the other end of the spectrum, you get equities. So equities are for a longer term investor. There you're looking to extract growth through the growth cycles. And I say cycles because it goes up and it goes down. We all know that. But through the longer term, you would expect to get a higher return profile. So that's more for someone, and we'll go through this, but more for someone who is younger and has a longer time to sit on the investment and doesn't need to withdraw immediately on that investment. And then just the last one, the last family, the broader family, is multi-asset. Multi-asset essentially combines interest-bearing and equities to get a blend of assets to meet a particular client's need. So you get income funds in multi-asset, low equity, medium equity, high equity. And it's all about the risk-return payoff for those investments.
So let's expand on some of that a little bit. So when we're talking about equity for investors, we're talking about shares in companies, and there are multiple ways of buying those. But in the unit trust world, you could buy those on companies on the South African market or global, and then also a blend of those. And just for myself, when I look at investing in shares as an asset class, my time horizon is probably 5 to kind of 15 years out. I'm certainly not putting money into shares expecting to sell those in 3 years' time. The market cycle, as you spoke about, could be against me if I'm worrying about getting money in 3 years' time. So I think from that perspective, it's important to understand. And then if shares, I always think of shares, if you're talking about like a car, shares is like the engine. It's the thing that makes it go particularly fast. But you also need brakes and shock absorbers and suspension and all of those things. And that's how the way you do that in investing is you start to blend your shares with things like cash, like bonds, maybe property companies, and you put that together. And so to the second part of, or that second sort of family that you're talking about, the multi-asset, important to understand that when you've got a lot of shares in a multi-asset investment, then you're aiming for a lot of growth, but that means that your brakes and your suspension are not as big, and therefore, when times are tough and markets are falling, the likelihood is that you will lose a fair amount as well in the short term. Not, and I think it's an important point, not permanently, but in the short term it could go down. On the other end of the spectrum, if you're not in a money market account or a fixed deposit, but you want a little bit of growth with very little risk, then you're into the kind of low exposure to shares. So the engine's quite small relative to the bonds and the cash, particularly. Maybe property would be small as well. And your hope there is to beat inflation, reasonably consistently, but you're not aiming to get all the returns of the stock market because you're not taking all of the risk of a stock market.
Yeah, spot on. So I think it brings you back to a simple concept, and that is that when you make investments, you must ask yourself some honest questions. So that's very appropriate given this is honest money. You've got to sit back and ask yourself some honest questions. And I say honest because a lot of people will skew their answers to something which is not the reality. Let me take you through some examples. So the key things you must ask yourself are, what are your time horizons? What are your goals within those time horizons? What is the liquidity requirement? In other words, what's the timing of the money that you might need to withdraw from your investment? And then last thing, which is probably the most important thing, and I quote Benjamin Franklin here, 2 things in life are certain. One is death and the other is taxes. And morbid though it might be, you have to focus on taxes because there are some very easy wins that you can make within investments as a personal investor just by understanding taxes.
Oh, and now you've just kind of flickered that shiny bright object in front of me. So tell me about the last point there, Rupert, about wins as an individual investor.
Right. Okay. So from a tax perspective, a couple of key things. Going back to those original investment categories, so you've got your interest-bearing investments. On interest-bearing investments, you get a tax exemption per annum. It's around 24,000 Rand for an individual less than or younger than 65, and around 35,000 Rand for someone older than 65, right? So you don't pay any tax on the interest income earned, and that's on bank products. It's on income provider funds that are quite popular within the market these days for retirees. And of course, this is outside of a retirement wrapper, so that's important to just put out there. But it makes a big difference because in an income fund, you get basically a little bit more than what the bank would offer you. So you're getting around 9% at the moment, but you're getting 9% clean. There's no taxes involved in it. And that's quite an attractive return profile, especially for someone who's, for instance, in their 60s or 70s. They know their requirements for cash. They want to earn something which is actually quite similar to a salary to fund their lifestyles, and they can do so with no tax on the first 30-odd thousand, let's call it that, right? So very first step that I would say is take 350,000 Rand of your cash and put it in an interest-bearing type asset to take advantage of that exemption.
So let's just stay on that for a second. So we're talking about, in that instance, an older person who gets that 35,000 a year, and they're looking for some income, and they want almost no risk from that income. I mean, I think very few things in life are guaranteed, as you said, except death and taxes. So let's just say this return's not guaranteed, but it's quite close to fairly certain that you'll get your 9%. So I like that point. Just to be clear, that's for a particular person. It's someone who's older, someone who's looking for income. If you're 21, 350,000 Rand in an income fund is not necessarily the thing for you. This is that's a type of investor.
Exactly, and that brings me to the next point, in that there is another, and there are actually quite a few tax advantages you can access, but another common one is that you get a CGT, so capital gains tax exemption per year. So that talks towards someone who's a bit younger, and yes, they are investing for the longer term. So let's call it, as far out as 50 years. So you can afford to take those that roller coaster, if you want to call it, of the ups and downs. But at the same time, you can harvest some of those gains every year and not pay the taxes, because very importantly, on that portfolio, you're going to be paying taxes at the very end. And that's a certainty, and that talk goes back towards the quote. So it's important to try and harvest those types of tax buffers, if you want to call them that.
And I think maybe just as another good tax kind of tip in this is don't forget your tax-free savings account, because I think for a lot of us as individuals, that's a really attractive investment. It's got a terrible name because the moment we say tax-free savings account, everyone thinks it's a fixed deposit or a bank account or something. It's not, and I think the key there is the questions you've raised. Those things about being honest with yourself and your objectives. All of those different kinds of investments can be housed inside a tax-free savings. So if you are young and you're looking for maximum growth, no problem. You can invest in something with a very high allocation to shares inside a tax-free savings account. Equally, the older person, they might, if they've capitalized, using your example, they've got their 350,000 rand of cash that's sitting, earning a lot of interest, and they're getting the interest exemption. If they still want some cash, but they're happy to leave it for the next 5 or so years, tax-free savings account also. So everybody in the age and risk spectrum can benefit from a tax-free savings account. And it boggles my mind that we don't all do it all the time. Our whole country should be putting as much as we're allowed into tax-free savings and as much as we can afford.
Yeah, spot on. I mean, the government has put it in place for the purposes of all of these exemptions for protecting investors, especially those who've got minimal capital or minimal money that they're living off of. That's why they are limited to a certain amount. But the government is putting it in place for the welfare of all of us as the citizens. So I'm surprised that they don't put out more educational materials on these sorts of investment opportunities.
It's almost like there's scope for a podcast about this stuff.
Spot on. Yeah.
So if we're now into the space of, I want to talk about the sort of multi-asset family a little bit more specifically. So, if an investor, let's say, is looking for a 3 to 7 year period for money, and that's fairly typical for a lot of us, because that might be saving for a car or putting down a deposit on a house. What's the kind of investments that they're looking for? What are the names of those kinds of categories of investments?
Yeah, so in multi-asset, you get access to many different types of investments. So broadly speaking, you get equities, so that's shares, stocks, etc. You get bonds, which is more fixed income focused. You can get things like money market and cash, and those three families will broadly classify a multi-asset fund. The thing about a multi-asset fund is that it takes the onus of the amount you should allocate to each of those categories. It takes it off your hands and puts it into an investment professional's hands. So the aim there is to structure a product which is in line with the client's needs. We go back to the original example, a high equity multi-asset fund for someone who's got a bit more of a longer term horizon. That person, as they go through their life cycle, they might then want to rotate as they get older into a medium equity fund, a little bit less risk, later on into a low equity fund, and then into retirement in an income fund. So that's the general idea behind a multi-asset offering. And that's how a lot of investments are run within the South African space in the retirement industry.
Okay, so if I'm in the space of saving for a very specific goal, and I'm pinning you down, Rupert, to my deposit on a house for 5 years' time. What's the kind of category of fund I'm looking for?
So 5 years, I'd say you're looking at a medium equity type fund. That's equity in or growth assets, let's call it that, around half your portfolio. The second half being bonds, less risky fixed income type asset classes, so that you have less of a roller coaster. And as a result, in 5 years' time, you have a much higher likelihood of ending up at that particular target that you've got. But as one point to make on that, I think a very good point is to average into an investment is one of the best things that you can do, and to average out of investment is also a really good idea. So especially with a fund that's a bit like a roller coaster, if you're going to put all your money in on day one, you could be at the very top of that roller coaster. And that's to a degree a random walk, right? So we can't predict it 100%. And as a result, you could then take a big knock. If you're averaging in and averaging out, think of yourself as getting on board the roller coaster at multiple times on that track.
I think it's absolutely brilliant advice, and especially when you've got a very specific end goal in mind. So, to use the example of the house, which is why I know it's a tough question to ask you, and you did it brilliantly there. But if you're saving for a deposit on a house, and it's going to be, you can't say to the estate agent and the lawyers and the seller of the house, look, just hang on 6 months, I'm waiting for the stock market to recover. That's not a chance. So then, if that goal is coming up, let's say 6 months from today, then sell 1/6 of your investment every month until you get to the end, where you then sell the last bit. And then if the stock market has collapsed in the last month, it's going to have an impact on your investment, but it's going to be small. Whereas if you waited until the last week to then sell your whole investment, and you've got such a specific goal in mind, and the stock market collapses, that it could leave you with less money than you were planning on. So I like that idea. I think feeding in or phasing in on the way in, and certainly on the way out, for particular expenses is really important. It's really valuable. The mathematicians don't like it. They always say you should just invest everything on day one, and just you'll win in most instances. But mathematics is not real life, and it doesn't deal with real human beings. And this is the Honest Money Show, and we are all people talking and listening to this show. So I think it's. I think there we're aligned. I'm trying to find disagreements to keep the show exciting, Rupert, but we're in alignment on this one.
Oh, we can go to crypto if you like there, Warren. No, we won't go down that way. I think, just carrying on from your point, if I can give any advice to someone who's starting out in their investment career, as an investor, just get going on day one and start, even if it's small amounts of money. And I know you'll hear this often, but just start investing. Put a debit order in for 100 Rand a month or 1,000 Rand a month, whatever it might be, and start building that portfolio, because time is your friend. In all of these investment products, time is your friend. And if you can have a 40, 50-year time horizon from when you started saving for retirement until you actually retire, you'll be retiring in a very happy space, playing golf every day, staying in the most amazing house, and just living the life that you've always dreamed of.
I think that's a brilliant conclusion. We're out of time, and it is the secret to the investment world is stay invested, try and protect yourself against the noise of markets and your friends who might be panicking or getting overexcited. You know your goals, stick to your goals, and the more you can stay invested for longer periods of time, the bigger chance you've got of living the life you want to live. Rupert, thanks so much for joining us. Rupert Hare from Prescient Investment Management. It was great to have you on the show again. I can't ask you my favorite question. You've answered it already. So we'll think of another trick question for you for next time, but I'm sure we're going to have you on the show again.
Yeah, thanks very much, Warren. Thanks to the listeners for dialing in.
Brought to you by Prescient Investment Management. Informed by science, guided by insight. Prescient Investment Management is an authorized FSP.